Hi, good evening, everyone. My name is Kate Allman, and today we're going to be talking about investment and risk management. One quick interjection is that I'm not qualified to be a financial advisor. I don't have any formal education, certificates, or degrees in finance, so do not consider this financial advice. But today I want to discuss, not as non-financial advice, introduction into investing and risk management from a non-financial advice standpoint. So we'll get into it. Obviously you should not take this as financial advice. Always consult a financial expert before making important financial decisions. Thank you, Benjamin Cohen, one of the best finance channels on YouTube. Today I want to discuss risk in stocks. And the first answer we need to understand is, if we're going to understand risk, well, what do we mean by risk? So, risk is the potential to lose money on an investment. That's essentially what I'm talking about. And if you understand or can quantify how much money you can lose in a stock, you can usually kind of engineer your financial outcomes in a better way. So, and you can tailor your investment philosophy and your direction to fit with more what you want. And so we're going to discuss kind of different understandings of risk. And so in this little lecture, I want to discuss these first two. So a very simple beginner's understanding of risk in the stock market and a basic investor's understanding of risk in the stock market. In other episodes, I'll probably talk about these different categorizations. But for now, let's understand more about a beginner's understanding of risk. So, what do I mean by a beginner? Well, here we have our beginner here, and I would describe this person as someone who does not know how to invest and does not have a history of investing, and so they don't know what to invest in. And thus, they'll usually listen to online advice. And since they don't trust their own opinions, or they don't really have any particular opinions or background on investing, they'll usually go to the internet or to some books to try to get beginner advice. Now, one of the most common pieces of advice that people will often be given is that they should invest in the S&P 500. This is usually what most people hear. And what is the S&P 500? Well, the S&P 500 is just a collection of the top 500 companies within the United States of America. But let's understand, why do so many people give this advice? And when I mean people give this advice, I'm talking about real financial advisors. So if we go to the next slide, we have our beginner here. And often he'll just hear invest in the S&P 500. But why does this person particularly hear this advice? Well, this is the best investor in the entire world is Warren Buffett. Hands down. He's the best investor in the entire world so far. And one of the quotes he's given in his own personal meetings is that he thinks most people should just be invested in the S&P 500. You also have the chief investment officer at Yale University, who also advocates for the S&P 500. And then you have Burton Malkiel, which is one of the greatest book writers for stocks, and discusses a lot more in depth about why you should invest in the S&P 500. Now, we can see the S&P 500 right here in this picture, and you can see pretty easily that, the S&P 500 has been going up. And this is, I think, the last almost 40 years of data. And just look how consistently it just goes up. If you look where my mouse is, right in the middle is 2008. For the last 20 years, it's just consistently moved up, without that many issues. And so, basically, the S&P 500 is just very reliable. That's why people like it. It goes up. And so one particular thing to know, which is really important, was the S&P 500, is that you only want to invest in the S&P 500 if you believe in the United States of America, because the S&P 500 is companies within the U.S. And so essentially, by investing in the S&P 500, you're basically investing in America. So this kind of stock, the S&P 500, it only grows when the United States grows, right? So if the United States is successful, the stock is successful. Now, should we expect the United States to be successful? Well, I have a few graphs I would like to show. So if we look at the top 15 universities in the world, 9 of them are in the U.S. We can see over 60% are in the top 10, over 60% are in the top 15. So the U.S. has really the best universities in the world. And the U.S. leads in so many areas. The U.S. also has the strongest military in the world. So that gives it kind of an advantage that it's unlikely to be attacked in the future. Especially because the United States relatively has good relationships with Canada and Mexico, and both these countries are not likely to win a military conflict with the U.S. So because we have a strong military, the strong military will protect the businesses that exist within the U.S. And then, if we look, like I discussed, we have most of the world's leading universities. But, if I asked AI, what are some fields the U.S. leads in? The U.S. leads in software, AI, medicine, semiconductors, aerospace, cybersecurity, finance, e-commerce, and you could go on and on and on. But the U.S. has such a monopoly on some of these fields, really important fields, that that because of this monopoly on these really important fields, and because we have such a strong military, and because we have the greatest universities, this kind of contributes to the position that the U.S. is in today. And kind of on top of this is I think, and not only that, but the U.S. actually has pretty good economic management by the Federal Reserve. So I've asked, Grok, can you give me countries that have, in the last 10 years, who've had consistently larger inflation and consistently larger unemployment? Both things which usually indicate a bad economy. Well, we can see China, India, Brazil, Turkey, Mexico, Germany, France, Italy, Spain, Canada. All of these have higher unemployment, and lots of them also have higher inflation. So, in terms of inflation and in terms of unemployment, the U.S. does a better job. And so, yeah, there's a pretty strong reason why the S&P 500 is a lot better than a lot of the other countries' stocks and these other, non-U.S. stocks. U.S. stocks have this advantage. They have a highly educated population. They have a strong military that will defend them. Generally, the U.S. economy is less likely to have issues with inflation and unemployment. I mean, the U.S. is kind of managed a lot better and has so many strategic advantages over a lot of other countries. And here's an interesting chart I want to look at. So what I've done is I've taken the GDP of China, which is the GDP of China is how economically fast the country is growing. And we can see for the early parts of the 1990s, so early parts of the 2000s, China's economy has been outgrowing the U.S. But if you look for the past almost 5 years, the U.S. economy has been outgrowing China, which that might not sound that impressive. Oh, you're only talking about the last 5 years. But the reason why this is really astonishing that the U.S. economy is outgrowing China is because China has a smaller economy So it should be easier to grow. The economy, you can think of it like a snowball, right? If you get a snowball and you add another handful of snow, it grows. Where if you have a big snowball already, you have a big snowball, and you add a handful of snow, it's not going to grow it that much, right? So because China's snowball is a little bit smaller, adding more snow into it should actually grow it faster and bigger than the U.S. It should be easier to grow. That's what I'm trying to say. But the U.S. is outgrowing China, at least for the last 5 years. I can't look into the future, but this is pretty astonishing because China should have the advantage in growth because they're smaller, but the U.S. is beating China. We can look at India, and you can kind of see for the last, 10 years, India's really done nothing. And actually, if you look, it's hard to see, but technically it's slightly declined, which is also pretty crazy because India's economy is also smaller and should be easier to grow. So this is pretty... I was expecting at least one country to outgrow the U.S., but there's not many. And you can look at Canada versus the U.S., and for the last 15 years, it's just plummeted down. It's just plummeting all the way down. The U.S. has completely outgrown Canada in so many ways. Economically, we do a better job with inflation. We do a better job with unemployment. We have more companies. But, you can just see, the U.S. economy does so much better than Canada. And lastly, we can look at Germany, Germany is the biggest economy, one of the biggest economies in Europe. I think it's the top 2. I think it's the biggest economy. I could be wrong on this, but you can look for the past 30 years. The U.S. has completely smoked Germany, just completely, in every single way. The U.S. and this should not happen. You were looking at these graphs. The German economy is smaller, so it should be easier to grow. The Canadian government economy is smaller, so it should be... the Canadian economy is smaller, so it should be faster to grow. The Indian economy is smaller, so it should be growing. And China has a smaller economy, and it should be growing, but it's not. It's not outgrowing the United States. So this is the Chinese GDP divided by the U.S. GDP. This is India versus GDP divided by U.S. GDP. Canada GDP divided by U.S. GDP, Germany GDP divided by U.S. GDP. So, the U.S. has so many advantages. And so, this is what makes the S&P so reliable. Because not only do American citizens want to invest in the top 500 companies, but actually, a lot of the world, in places in India, China, wherever, they will invest in U.S. stocks if they're allowed to, because U.S. stocks, they grow. And so, going back, this is the reason why people invest so much in the S&P 500. Best schools, strong military. Even though a lot of countries are smaller, we're still growing faster than them, which is amazing. We lead in the most profitable fields in the world. Medicine, AI, nuclear. Let's see, what else? Aerospace, cybersecurity, finance, just everything. Coding. It's pretty impressive. So the S&P 500 really is a pretty reliably good stock to invest in. And then this is why the greatest investor considered the greatest investor in the entire world tells people just buy it. So this is where this advice comes from, basically. And, another interesting thing to think about is, okay, the S&P 500 is very reliable, right? But one interesting statistic is when you ask AI, okay, when people choose their own stocks, are they more likely to beat the S&P 500? Or would they have done better if they just chose and stuck with the S&P 500? You can see this where my mouse is. Over the past decade, the average equity fund investor returned 10% annually versus 13% for the S&P 500. So usually when someone invests on their own terms, they make 10%, where the S&P 500 for the last like 10 years has made 13%. So they would have made more money just sticking with the S&P 500 instead of choosing their own stocks. And, you know, they say like studies showed that usually most individuals would make 2% when the S&P on average does like 8%. So the S&P 500 over long periods will do 3 times more than what most people can do. So yeah, this is a pretty interesting statistic, at least with some of these studies that you should do your own due diligence and look up. So this really presents us with our first risk, which is opportunity, the opportunity cost, or opportunity risk. So usually by choosing your own stocks, you're taking away money that you could have just invested in the S&P 500. And since the S&P 500 is so reliable, you're kind of losing money by just not putting your money into a more reliable and better asset, right? So a lot of the times, by not choosing to invest in the S&P 500 and by investing in something else, we usually just harm ourselves because our money would have just been better off in the S&P 500. And so because of opportunity risk, most people just go with the S&P 500. And so even though this picture right here, I kind of have a picture of a Neanderthal, a caveman, actually investing in the S&P 500 is actually really logical. And it's built on decades and decades of mathematics, science, research that just shows the S&P 500 is one of the best things to actually invest in. And so this is actually pretty reasonable for beginners to invest in the S&P 500. Why would you put your money into something that you don't really understand when the S&P 500 just consistently goes up? And the U.S. just has such a strong position in the world that it's likely to go up in the future, right? So I shouldn't be so quick to judge. People shouldn't be quick to judge beginners, especially when you're invested in the S&P 500. This is pretty valid advice, in my opinion. Not financial advice. But, I mean, there are good reasons to invest in the S&P 500, so don't feel like you need to invest in anything else. I think a good investor probably has a lot of money in the S&P 500. So this is kind of a beginner's understanding. Well, this is a beginner might not be able to articulate why they invest in the S&P 500, but this is the underlying logic why they are told to invest in the S&P 500, and this is why most people listen and just do that, right? It's a lot easier to just put your money in the S&P 500 and have it grow than risking it in some stock you know nothing about that is probably not even going to do better than the S&P 500. So, yeah, this was basically a beginner's perspective, which is actually valid, into investing and just putting their money in the S&P 500. Like the best investor ever was saying to do. So yeah, we can go on to our next topic of discussion, which is risk number 2, which is non-diversification. So before we discuss diversification, a more kind of savvy, sophisticated investor will try to understand if they do want to try to, this type of investor wants to level up their game. So this type of investor, instead of going to the S&P 500, they kind of want to mix it up. They don't want to sit in one asset, right? And so a more kind of sophisticated investor will look and see how they can quantify risk. How can they actually look at a stock and determine if stock A is riskier than stock B, right? And come up with some numerical way to evaluate the risk of their portfolio and the stocks that they're going to invest in. So how might we approach this, okay? How can we quantify a stock's ability to lose money or potential to lose money? So let's say we have some numbers, right? We have the S&P 500 here, which has a 10% chance of losing money, and has on average it does a 10% return. Well, a pretty smart investor might look at this, and they'll take the return, the average return of a stock, which is pretty easy to calculate. You just look at, usually, you just go every single year, you look at the stock, the price at the beginning, the price at the end, and you see the percentage change, and you just go through every single year. You take up the percentage changes, you divide them by the lifetime of the stock, and you get some return. So the S&P 500 usually does around 10%. So this is actually pretty realistic. However, this number is just fake. I made this up. But let's give this for the sake of example, right? So if we take the return, which is 10%, and we divide it by the potential of losing money that year, we can see we have some number. This number means we're taking on 1 unit of profit for every unit of risk, whatever that risk means. But with this process, we can actually quantify how advantageous, how much money we're getting for how much risk we're taking on. Okay. And a more savvy investor will do this. He'll look at stocks and he'll compute these values. And we'll discuss this more thoroughly in the upcoming videos. But here's an interesting thought. We know how to do it with one stock. We just looked at this stock's statistics and we just computed the return risk ratio right here. So how much do we profit per unit of risk? Well, can we do that with 2 stocks? And what would it look like if we invested in 2 stocks? How would our, risk-adjusted returns, or how much better would our profit be? How much more money would we make if we just diversify with 2 stocks? So let's say we put our money in the S&P 500, and let's say we just put our money into gold. We buy gold, okay? Well, we have some interesting things that happen. So we see that the S&P 500 has a 10% chance of going down a year, and gold also has a 4% chance of going down a year. So if we look at this, for both of these things that happen at the same time in the same year, we would do 4% divided by 10%. And the number we get is we get not even 1% risk. We don't even have a 1% chance of bull stocks going down that same year. If you look at the risk, the scenario where they both go down is 0.004. Because if you know anything about statistics, whenever you use the and word, it's a multiplication. So we take the chance of this stock going down and the stock of this going down, and we multiply them to see the scenario, the risk of them both going down. And okay, what return should we expect for investing in both of these stocks? Well, we have an 8% return if gold returns 6% a year and the S&P 500 returns 10% a year. So these are our new variables. And when we take our return, a diversified return, and divide it by a diversified risk, you can see we're getting 2,000 units of profit for every unit of risk. If you remember, what did it look like when we just invested in the S&P 500? We were getting one unit of profit per unit of risk. If we go down, we're now getting 2,000 units of profit for every unit of risk we have. So this doesn't necessarily mean you're making 2,000 times more money, but it means more often than not you're gonna make more money, and you have less risk. Your stocks are less likely to go down. Your investments are both less likely to go down, but actually, in the long run, you probably make more money, given this ratio where you took the returns, divided by some numerical value of the risk, and then you got a risk-adjusted profit metric, right? Some unit. And you see this unit down here is way 2,000 times better than just being in one stock. This is really pretty astonishing. Like, this is really what diversification can do to your portfolio. However, there's one important note, is that we are assuming in this scenario that these assets are not correlated, meaning if one asset goes down, it's unlikely to put pressure on the other asset to also go down. Where they move together. We're assuming that these assets they kind of have their own independent moves. This usually isn't true. Assets usually move together. So while in reality, we would actually see more money and less risk in more investing in multiple assets. Like here, we invested in S&P and gold. Even though we would literally see less risk and more return, it wouldn't be to this same degree. It wouldn't be this exaggerated of an amount, because most assets, they kind of move together. So this isn't quite an authentic representation of this. But still, I mean, by being diversified, you get so much more. You're exposed to less risk and way more profit. So yeah, that's the kind of the power of diversification. And that's how a more sophisticated investor might invest. Now, one thing that's pretty funny, I think you just read it. One thing that I find pretty funny is when we look at the power of diversification, how we invested in one asset, gave us this, this measurement. Well, investing in two assets drastically improved the amount of returns we were getting and reducing the amount of risk, right? Well, if we think about the S&P 500, remember, it's the top 500 companies in the U.S., meaning it's already diversified for you. So this is one reason why the S&P 500 is good, on top of the other reasons that I listed in the previous slide. So this is why the S&P 500 is a really good stock. And that I think some people, you should always kind of have somewhat of a slice of that, in my opinion. And so, yeah, that's basically everything I wanted to discuss in this video. So in this video, we talked about opportunity risk and how most investors actually choose worse stocks than if they were, by choosing their own stocks, they are less successful than just choosing the S&P 500. We discussed why the S&P 500 is usually a good investment. It's because the U.S. has the largest military, the best universities, low inflation, low employment, and we are so successful as our GDP grows, even though we're the wealthiest nation in the world, we continue to grow faster than countries that are way smaller and should have an easier time growing. And then we talked about diversification, about how owning multiple assets can drastically improve our profitability because it reduces the amount of risk that we're likely to experience. And lastly, we discussed about how to quantify risk and return together. And so, yeah, this is my part 1 of risk analysis. The next part should be really exciting, and I hope that you're really excited for it. I'm likely going to cover how to actually compute a number for risk, how you can look at a stock and actually authentically get a score, a measurement of your return for your risk. And then I want to discuss kind of why some of these approaches fail, why some of these approaches actually succeed. And I want to discuss macroeconomics. So please stay tuned for that, and I hope to see you sometime soon. Thanks so much, everyone.